Hello and welcome to the next lesson as we begin to piece together the final parts of this model. We've spoken about accumulation, manipulation, distribution. We've spoken about higher time frame trends, candles. I now want to talk to you about another piece of confluence that we're going to utilize in our model, and that is divergence. Now, I did a lesson on divergence in the previous module. That was an introduction to it. I'm going to try and go and talk about it a little bit more here just to completely solidify your understanding on what divergence actually is and why we also have divergence in price as well. Now, you've probably heard the term SMT divergence, but it's a coined phrase for what it truly means, and that is divergence in price. And essentially, what divergence means is a possible sign of a reversal in the market. That is basically what we can expect when we see divergence happening. Now, we're going to talk in future lessons about the best types of divergence that we're going to look to utilize here. And we're really going to try and simplify that down because divergence is important to consider when you see it everywhere, because you're not always going to get the higher probable and the less probable in terms of divergence. But what divergence truly is a possible sign of a market reversal. And at the very start of this program, we're talking about trading on one particular pair. But what my chart looks like is actually something a little bit more like this, where we're utilizing three different pairs in price. Now, you can be focusing on one pair here, but as long as you've got another screen which has other pairs intact, that is what's going to help drive you towards better trading decisions. And the reason we're utilizing more than one pair is because pairs like the NASDAQ and pairs like the S&P are pairs which basically correlate together. They are pairs which should be moving in tandem with each other. Vice versa, if you're trading with Euro USD, you would be looking at the correlation between Euro USD and Pound USD right here. And again, if you're looking at something like gold, you would be looking to trade that in correlation with silver. And if you're looking at the correlation between possibly Bitcoin, you would then want to be checking another pair which should correlate with it, and that would be Ethereum as a good example. So there's plenty of examples that we can go on. These are kind of like your main examples. And if you're looking at all of these charts here, Bitcoin, gold, NASDAQ, Euro USD, you also want to be considering the correlation between certain pairs, such as Ethereum to Bitcoin, silver to gold, S&P to NASDAQ, pound USD to Euro USD as well. And what it means when they're all moving is that they should all essentially be driven towards driving in the same direction. So if one of these pairs on the left over here is essentially moving in the same direction over here on the right with these pairs, that is price moving in tandem with each other. So everything is singing and dancing and working completely fine with each other. Now, the way we are able to spot a reversal is by marking out a previous high or a previous low and identifying that there has been a potential move, because one of these pairs will do something like that. And when there is an unwillingness here from compared to this one here, where there is a willingness, this is doing one of two things. This is, number one, confirming a liquidity sweep. And number two, the other pair is showing an unwillingness to come higher, meaning that pair has a higher relative strength in a certain direction. So with that in mind, what we can basically gauge from seeing here is Over on this side, we have swept this high. The high has been taken. And over here, high has not been taken. So this pair over here is showing an unwillingness to reach this particular high. So over here, you've got liquidity sweep right here. And over here, what this is showing is an unwillingness to go higher. So therefore, we have got potential divergence in place. Now, the reason I say potential is because it is vital that the price, the candles actually close in price. If they don't close, this could basically just carry on moving higher. This could be a delay in price action. Now, where we would look to engage in the market would not actually be right here. There's a couple of ways that we're going to look to engage in the market after we see divergence in price, but mainly what we actually want to see is a clear shift to the downside. Something like this would be what I would want to see essentially play out. And within this particular area here, I am looking for some form of imbalance. That can be some form of imbalance. That could be an inverse fair value gap. It could be an order block. It could be an OTE level. It could also be a balanced price range. And basically, when we see these particular levels in play, after divergence has happened, that is going to give us an entry in the market. Now, the target would be any opposing level of liquidity. So you would be targeting the next area of liquidity. So this would be liquidity down here, for example. And the liquidity that you find has to give you at least a 1 to 2 for you to take this entry. Your stop loss is going to come above the divergence that you see in price, and vice versa over here as well. The same entry, let's just say it's randomly in here somewhere. We're looking for a 1 to 2 in price right here. And your stop loss would be above the high that was not necessarily taken. So these would be your two entries in this particular model right here. And what you're aiming for here, the rules that you're going to need to write down is that you need a 1 to 2. Without a 1 to 2, you're not taking the trade. But for a 1 to 2 to be intact, you need to have liquidity as well. So basically, the rules for entry are as follows. Stop loss above divergence. Your liquidity target has to equal a 1 to 2, because basically if it's anything under a 1 to 2, price action is not going to be as high in probability. Okay, so these are the things that you're going to be looking for in price. Now, out of these particular examples that I'm also showing you here as well, we are trading a certain pair. Now, you could, in all honesty, trade either or. And in honesty, I trade either or. I trade what I feel like looks best. I'm intuitive. I look at what potentially looks best in this example. However, there is a certain pair which would be higher in probability, and that would be this particular pair here. Now, the reason this is higher in probability is because this is showing higher relative strength to the downside, which basically means this is going to offer more volatility. How do you spell volatility? Um, I apologize if I got that wrong. So the higher probable move would actually be taking this particular pair here, which sounds crazy because I've always been talking about liquidity sweeps. And in all honesty, you can still enter on here, but now we're utilizing this particular pair over here compared to this one here, which has not taken the high. But you've still got a liquidity sweep in price. You've just got it on another pair now. So this is an example of the divergence that we're going to look to basically utilize in price. Now, where we find divergence is going to be for another lesson. This is just to give you another rundown of really one of the most powerful confirmations in price. And if you go onto your chart now, you will actually see that divergence is pretty much everywhere after a reversal in price. So you can see here, we swept these highs. Now I'm utilizing a third pair because we look to utilize 3 pairs on these as well. I've done an example over here for the sake of 2 pairs, but actually we're looking at 3 pairs as well. And you can see that after this pair right here on the NASDAQ showed an unwillingness to come lower, but we came lower on S&P and we came lower on the Dow, this pair completely shot to the upside. So you could have potentially looked for entries that were sitting inside this area here. If you look at this real-time price action now, you will see that price action has swept that low. But over here right now, we are respecting this particular low right now. So if we got, after this example right now, which is playing out, if price action from this area shot to the upside, created one of these entry levels inside this area here, or inside this area right here, and vice versa inside this area right here, you would have a potential entry happening in one of these areas. Now, the higher probable move based on what we see here is probably going to be on the S&P and on the Dow, because these are the ones that are showing an unwillingness to come lower at this particular stage. However, we do not trade this model on divergence alone, and we need a few other confirmations to be in place before we look to engage with this any further. This is kind of like the cherry on top in terms of actually taking entries in the market, and I'm going to talk about that in future lessons. But I just wanted to give you a little bit more of a detailed rundown on divergence in price, what it exactly is, what we look to engage with it, how we look to do it. And I would say go and have a little look and do some back testing. I'll provide more examples of this as well, just for some clarity, because like I say, divergence really is everywhere in the market. If you look here, for example, you can see this high was respected, and over here, the same high on the NASDAQ was respected. But if we look over at the S&P, the Dow, sorry, you can see that we had a run on that high right there. And if we look at what happened after this here, we had this area of imbalance presented to us in here. So your entry theoretically could have been anywhere inside this level right here with your stop loss above here, or in fact, because that was the divergence, this would actually be your entry. Now you could have your stop loss above here. You could be targeting something down here. Because this is a very big gap, maybe you had your stop loss here, you could be targeting a 1 to 2. You'd have been in profit based off this trade. And that's an imbalance. There's an order block in there as well. You've got this balanced price range on this side. You've also even got an entry which is sitting in here as well. But the higher probable one would be the pair that did not sweep the particular high. But go and do some back testing. Go and see every reversal that you find. Go and have a look at them. See if you can notice and spot divergence in price. If it is obviously something you are unsure of, please go and have a look and let me know if you have any questions on this. But other than that, I will speak to you very, very soon.